Family offices and institutional venture capital, VC firms, are two distinct sources of funding for startups, each with different structures, motivations, and impacts. While both provide crucial capital, the nature of their investment and the relationship they build with a startup can be vastly different. How family offices and institutional VCs are different. Source of capital: private wealth of a single family or group of families. They are not beholden to outside investors. Pooled capital from multiple limited partners, LPs, such as pension funds, university endowments, and other institutional investors. Investment mandate: highly flexible and can be driven by the family's personal values, legacy, or specific interests. They may not have strict investment criteria and can be opportunistic. Operates under a strict mandate defined by the fund's LPs. They often focus on specific industries, stages, for example seed, Series A, or geographic regions. Time horizon: patient capital with a long-term perspective, often focused on preserving and growing wealth over generations. They are not constrained by a typical 7-10-year fund cycle. Bound by a fund's life cycle, typically 10 years, which creates pressure for portfolio companies to achieve a successful exit, IPO, M&A, within that timeframe. Decision-making can be relationship-driven and less formal. The decision-making process may involve family members, personal advisors, and a small professional staff. Highly structured, data-driven, and formal. Decisions are made by a professional investment committee with extensive due diligence and analysis. Risk tolerance: can be more conservative but also willing to take on significant risks for opportunities that align with their interests. They may invest in high-risk early-stage projects that other VCs might avoid. High-risk, high-reward. They are built on the premise that a few home-run investments will generate significant returns for the entire fund. Control and involvement varies widely. They may prefer a more passive role, or they may want to be deeply involved, leveraging their personal and business experience to help the startup. Often take an active, hands-on role, including a board seat to provide strategic guidance, network connections, and operational support to accelerate growth. Impact of the funding on a startup. The type of funder a startup chooses can have a profound impact on its trajectory and culture. Impact of institutional VC funding. Accelerated growth. VCs are geared for speed and scale. Their funding is designed to help startups grow as quickly as possible, often with the goal of achieving market dominance. Strategic support and network. Beyond capital, VCs bring a vast network of industry contacts, potential clients, and future investors. They provide valuable mentorship and operational expertise to help the startup navigate challenges and achieve product-market fit. Pressure for a quick exit. The fund's lifecycle creates pressure on the startup to achieve a liquidity event, for example IPO or acquisition, within a defined time frame. This can force founders to prioritize short-term growth and may not be suitable for businesses with a long development cycle. Increased scrutiny and oversight. VCs are not just passive investors. They often demand a high degree of control and accountability, which can include a board seat and regular reporting. This can sometimes lead to a loss of creative control for the founders. Higher valuations and follow-on funding. A strong VC backing often signals credibility to the market, which can help a startup secure higher valuations and attract follow-on funding from other institutional investors in later rounds. Impact of family office funding. Patient and sustainable growth. Family offices' long-term horizon allows startups to focus on building a sustainable business without the pressure of a looming exit deadline. This can be ideal for companies in industries like deep tech or biotech that require years of research and development. Values. Alignment. Many family offices are increasingly engaged in impact investing, aligning their capital with their personal values, such as sustainability, social good, or specific philanthropic goals. This can provide a powerful mission-driven partnership for a startup. Flexibility and customization. Family offices can be more flexible with deal terms and may use various investment instruments, equity, debt, convertible notes, to best suit the startup's needs. Strategic connections and industry expertise. If the family made its wealth in a particular industry, they can offer invaluable first-hand experience, mentorship, and access to their established business network, supply chains, and customers. Potential for concentration risk. A startup that relies heavily on a single family office for funding can face a challenge if the family's priorities or liquidity needs change. This can create a dependency and a potential funding gap if not mitigated by a diverse group of investors.